Hello friends, how do you do? Welcome to the world of accountants. For another episode, today we want to talk about a different type or a different method of calculating depreciation expense. We had looked at various methods of calculating depreciation expenses. The other time we started by talking about the straight line basis of calculating depreciation. We went to the reducing balance method of calculating depreciation. The other time we had a look at the revaluation method of calculating depreciation expense. And today we want to have a look at another method of calculating depreciation expense. This channel is on YouTube and it's called Simplified Accounts Guru. Just click the Simplified Accounts Guru on YouTube and you'll find this channel and you'll be able to appreciate the kind of contents that you'll come across. This is done by CP Otieno. So today, without wasting much time, allow me to enter into the 9th lesson. And today we want to introduce another method of calculating depreciation called the depletion unit method. Now, the depletion unit method, this is where the non-current assets such as a quarry from which valuable materials are dug out to be sold to the building industry. A different method is needed called the depletion unit method. One thing that you need to keep in mind each and every time when you are dealing with the depletion method is that we are talking about an asset that is being depleted each and every time. So what is it that is supposed to be? You know, when we are talking about depletion, there is the loss in value still. So the loss in how is this asset losing value? Remember, we had talked about land. We talked about land as a fixed asset, and we mentioned that land appreciates in value. But this is a circumstance where we realize that there are particular types of land where depletion takes effect. How do we encounter depletion on a land? When we have land from which certain valuable materials are supposed to be dug out to be sold to the building industry, the extraction of those valuable materials, as that one takes place over time, the value of that land will reduce. The value of that land will go down. So the reduction in value, that is what we call the depreciation expense. The reduction in value is what we call the depreciation expense. And that is what we calculate using the depletion unit method, because we have now a special type of asset which now is expected to appreciate, but instead, because of one reason or another, we are being given a circumstance that forces the asset to reduce in value. And that is why we are having the term depletion unit method. We take the number of units of the valuable materials that have been extracted within a financial period and then divide it by the expected total quantity of valuable materials expected from that land. Then you multiply your answer by the cost of that fixed asset. Then you will get what we call the depreciation expense. So land has been depleted to that extent within that financial period. You can see an example that we are having here, that if a quarry was bought at $5,000 and it was expected to contain 1,000 tons of sellable materials, then for each ton taken, we would depreciate it by $5, which means that $5,000 divided by 1,000 tons gives you $5 per ton. So each and every ton that you take out of the sellable material, then it means that your land is being depleted by $5. Now, this is the formula that we are supposed to be looking at. So depreciation expense within a financial period is given by the number of units taken out within a period divided by the expected total contents or the total quantity expected from that particular land. Then you multiply by the cost of the fixed asset. The fixed asset in this case is that land which carries the valuable materials. Now, I'll take you to an illustration where we can be able to demonstrate the calculation that we have talked about in the formula. Now, the illustration that we are having here says, on 1st January 2012, a gold mine was bought at a cost of $200 million, then it was expected to contain 50,000 tons of gold. In the year ended 31st December 2012, 10,000 tons were extracted from the mine. In the year ended 31st December 2013, in the year ended 31st December 2013, 15,000 tons were extracted from the mine. And then lastly, in the year ended 31st December 2014, 22,000 tons were extracted from the mine. Now, required. These are the items that now we are going to respond to. Number 1, find the depreciation expense for each financial period since the time of purchase up to 2014 using the depletion unit method. Number 2, find the value of accumulated provision for depreciation on the fixed asset, which is the mine, as at 31st December 2014. Number 3, which is the last one, find the net book value of the fixed asset, which is the mine, as at 31st December 2014. Now, let us go very fast into doing the solutions or demonstrating how we can handle that question. Question number 1 was asking that we find the depreciation expense for each financial period. Now, we are going to start with the first financial period. In the year ended 31st December 2012, we have 10,000 tons were extracted from the mine. So these are the items that we need to keep in mind even as we handle this question. The original cost of the mine was $200 million, and also the estimated number of materials, remember the sellable materials, which is gold, amounted to 50,000 tons. So now the depreciation expense for the financial period ended 31st December 2012 is supposed to be given by number of units taken out in a period divided by the quantity of contents expected in units times the cost of the fixed asset, which had been given as $200 million. So we are just going to replace the items which we have in the formula. So for us to come up with the answer, the depreciation expense will be given by the number of units taken out in a period. Do we have that? Yes, we have 10,000 tons were extracted from the mine in the year ended 31st December 2012. So that becomes the number of units taken out in a period within the period that we are looking at. So take 10,000, replace with the numerator, and then the denominator we are going to use the total quantity of contents expected in units. So the estimated number of materials is 50,000 tons. So we are going to have 10,000 tons divided by 50,000 tons multiplied by $200 million. And you will have 1/5 times $200 million. Then your answer will be, the depreciation for that financial period is given as $40 million. So that is answering question 1, part A, which was asking about getting depreciation as at the end of 31st December 2012. Then the next one was asking, we get depreciation expense as at the end of December 31st, 2013. In the year ended 31st December 2013, 15 tons were extracted from the mine. Original cost of the mine is equivalent to $200 million, estimated number of materials, 50,000 tons. Still, our formula stands, and then we just replace. So we'll be having, instead of the 10,000 that we had used in the first case, so we are going to have 15,000 tons divided by 50,000 tons, and then the result you multiply by $200 million. Then you will get your answer as 1.5 tons divided by 5 tons multiplied by $200 million, giving you $60 million. So the depreciation expense as at the end of 2013, December 31st, is $60 million. Then the next question, which is asking about as at the end of 2014, December 31st. So we are told that in the year ended 31st December 2014, 22,000 tons were extracted from the mine. Now, the original cost of the mine is equivalent to $200 million, and the estimated number of materials was 50,000 tons. Now, the formula was given as the number of units extracted from the mine within the financial period divided by the total expected quantity of the sellable materials multiplied by the cost of that asset. So you'll have that as 22,000 tons divided by 50,000 tons multiplied by $200 million, which gives you the end result shall be $88 million. So that is the depreciation expense for the year ended 31st December 2014. Now, we are moving on, and we would also want to have the second question, which was asking about find the value of accumulated provision for depreciation on the fixed asset as at 31st December 2014. So here, the accumulated provision for depreciation is equivalent to, now accumulated provision for depreciation is given by we are summing up. When you come across the word accumulated, so it means that it is not one figure, but it is a summation of several events or several instances of calculations. So we want to get, the first instance was depreciation expense as at the end of 31st December 2012. The second one was the depreciation expense as at the end of 31st December 2013. Then the third one was the depreciation expense as at the end of 31st December 2014, which we got as $88 million. So if you sum up the three, you will get $188 million. So that becomes the accumulated depreciation. And then the third question was asking about find the net book value of the fixed asset as at 31st December 2014. So the net book value, when somebody talks about net, the word net is something that has been sieved. It has passed through some sieving, and there are some residues at some point, and then you are being given the finer details after subtracting something. So that is the net. The original cost of the asset minus the accumulated provision for depreciation, so that you end up with the net book value. So in this case, the net book value is, we have $200 million minus $188 million, which gives you $12 million. So the net book value of the mine is $12 million. We come to the end of this lesson, and I believe by now you understand what we have discussed about the depletion unit method. Under depletion unit method, what is much more important that you need to keep in mind each and every time is that you are supposed to know the original cost of the asset. Then number two, you are supposed to know the total estimated quantity of sellable materials that the business is expecting out of that particular asset. And then when you are asked about the expenditure, or rather, when you are asked about the depreciation expense related to that particular asset, then you should be able to pick the number of units of the sellable items that have been extracted from that fixed asset within the financial period that you are looking at, and then divide by the total expected number of units of the sellable materials within the land. Then you multiply the result by the cost of that land or that fixed asset. Otherwise, I think that one has taken us to another step, and I believe up to this point now we can be able to understand everything about the depletion unit method. So under depletion unit method, each and every one of us now know very well that we have to keep in mind three things each and every time you are asked about the depletion unit method. So you have to know the quantity that is expected of the sellable materials from that particular land or from that particular fixed asset. Each and every time you have to know that. And also the second item is you have to know the original cost of that fixed asset before any sellable material is extracted from it. Or at the point of sale, at the point of purchase, what is the total number of sellable materials in units that we expect from that asset, and the total and the cost, the original cost of that asset at the point of purchase. Then you match that alongside the number of units that have been taken out, the number of units that have been extracted of the sellable materials within the financial period, so that you can end up with what we call the depreciation expense for your financial period. Otherwise, thank you so much for having watched the video to the end. Be blessed. Until another time. Thank you so much. My name is CP Otieno.